Is there anything about that cycle that we're in right now that has surprised you?
Yes, the business cycle hasn't picked up yet. Normally, the ISM would have picked straight up, and we would be now with the ISM at, let's say, 57 or something, looking for the peak. But we're not. We're below 50. But the forward-looking indicators suggest that it still continues as normal. So what we've done is taken a business cycle that's this long and stretched it out a bit longer. And what we've seen is this year was that, the extra year in the middle.
Raoul Pal believes the crypto market is going through a temporary slowdown, not a collapse. The lack of liquidity has made things feel sluggish, but he emphasizes this is just a natural pause before the next acceleration phase begins. He points out that institutions are positioning quietly while retail investors panic, missing the bigger picture. Pal sees this period as a setup for significant moves in Bitcoin and other digital assets as liquidity conditions improve. Looking ahead, he expects 2026 to be a landmark year, with crypto reaching unprecedented levels of adoption and value. To him, this is not the end of the cycle, but the calm before a powerful new wave of growth.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
You mentioned you wrote the first macro paper on Bitcoin in 2013. How has your thesis changed from then to how it is now?
I didn't understand the debasement of currency at that time. We understood something was going on with the central bank balance sheets, that it was driving markets. We didn't really understand any of that. But my thought process was, at the time, Bitcoin was $200. And I said, listen, it's either worth zero or this is the future of the entire financial system and everything will get recorded on blockchain. And then we know who owns what. And that was my simple thesis. And I said, listen, if I just use gold as the basis of understanding, I can impute like a stock to flow, how much gold is above ground versus known supply, reserves of gold, and do the same for Bitcoin. And I got, well, Bitcoin's probably worth $1 million. And that was when gold was like $2,500 or so. And I said, okay, well, let's discount me by 90% because I don't know. So Bitcoin's at least worth $100,000 and it's only $200 now. I said, this is the greatest trade the world has ever seen. And it proved to be so. And it's the same thesis, is blockchain rails are the future of the financial system. I just didn't realize, because smart contracts weren't around then. But when smart contracts came out, well, it's the future of the internet as well.
You also said that crypto is the biggest or best macro trade of all time. When you speak about crypto, do you mean Bitcoin, or is Bitcoin a different asset class by now?
No, Bitcoin is one of the elements of crypto. So crypto is the use of blockchain technology at scale for the future of the internet and the financial system. Bitcoin is the collateral layer of the system. And it was I who coined the term pristine collateral back in 2020 to say, here's a collateral that can't be debased, that's globally accessible, that's fractionizable, and is immutable. And therefore, this is a great form of collateral, except its volatility is very high. But over time, as networks adopt, the volatility comes down and it becomes more manageable as collateral. So that's Bitcoin's role in the system. But that's a small part of the overall space. So if we're going to $100 trillion, how big is Bitcoin in that? 20 trillion? 25 trillion? Well, there's 75 trillion of other value. And that's what crypto is. It's the technology part of blockchain. How else can you use blockchain? And it was smart contracts that really changed everything.
What's the debasement trade? What's the play here? And also, what's happening right now with gold? How does that fit all together?
So the debasement trade, we talked about we're creating excess money to service the debt. That comes with a cost. What is that cost? It's like people don't really see it. They don't feel it. You don't know what it is. What it is you are lowering the purchasing power of fiat versus scarce assets. So $1 today buys you, well, $1 million today buys you less of the S&P 500 every year because the debasement of the fiat currency. Real estate, gold, crypto, art, classic cars, anything that is scarce value holds value. This is exactly the same that happened for the Venezuelan stock market. In Bolivar terms, it was up 1,000,000% or whatever stupid number it was. When you look at it in dollar terms, it was down 99%. Why? Because they debased the currency to zero. And so that's currency debasement. It's happening about 8% a year on a globalized level because all the major central banks and governments are doing this. So the debasement trade is, if this is the most powerful macro factor of all time, what are the things that offset it? Now, Wall Street is very slow on the uptake, so their first thing is gold. But measurably over time, gold has not meaningfully outperformed debasement because its job is to actually just be stable money and have a stable store of value. So therefore, you're not getting richer owning gold, you're protecting yourself from the debasement. Fine. But if you're going to lock up money in long term by buying an asset, you need to get rewarded for locking your money up. So to be rewarded, you need an asset that outperforms that debasement. So Wall Street's finally caught on to this. It's something I've been writing about extensively, probably have done more research on this than anybody else in the world. And now finally Wall Street's starting to understand the game, which is that scarce assets outperform. Okay, now they've all gone to gold, but gold, as I said, is a store of value, but is not a compounder of wealth. But why has gold been outperforming recently? Because there is what we call the global macro investor GMI dominoes, where things affect. There's a chain in terms of time of what works. At the front end of it all is financial conditions. How we measure financial conditions is interest rates, the dollar, and commodity prices. You kind of put a regression analysis around those, you create an index. That leads the ISM by about, which is the business cycle, by about 9 months. So that's the most forward-looking thing that we have. Then we've got global liquidity that lags by about 3 months or 6 months. I can't remember the exact number. And then we've got the business cycle. Assets fall somewhere within those, and then there's some assets that are lagged. But the business cycle is the main driver of assets in cyclical basis. On a secular basis, it's debasement, and financial conditions lead all of that. What we found is that gold has shifted its correlation from being about real interest rates to now being about financial conditions. So think of gold leading Bitcoin by 6 months. That's the work that we've done, that we think it now actually leads, because Bitcoin is liquidity. That's the key driver. Gold is being driven by this future thing, which is financial conditions. So they're all part of the same thing, but just different phases.
Raoul Pal believes the crypto market's current slowdown is only temporary, caused by tight liquidity rather than structural weakness. He explains that while many investors see this as a bearish signal, it's actually a healthy pause that sets the stage for the next major rally. Institutions, he notes, are quietly positioning themselves during this lull, preparing for what's to come. Looking ahead, Pal expects 2026 to be a defining year for crypto, marking massive adoption and capital inflows. He predicts that Bitcoin and other digital assets will lead a new phase of wealth creation, fueled by global liquidity and expanding institutional interest.
But how is Bitcoin different from any other hard asset?
Because it's networked. So it's built for the internet. It's a networked asset. You don't know who owns what gold, but you know every single thing that happens with blockchains. You've got an asset where the more you talk about it, the more you onboard people, the more the value goes up. So you have behavioral incentives built in to bootstrap this network. So Meltem Demirors, an investor in the space, one of the OGs, has said, we memed a $2 trillion asset into existence. And we did, because we decided it has value, it had value. We built social consensus. That's never happened outside of gold. We built social consensus around some code and said this is a better form of value. And so it's been a very different journey, because once you look at how networks are valued, they're valued by something called Metcalfe's law. And Metcalfe's law is based on the number of users on a network and then the total value transacted on that network. That is why Amazon stock has been so good, and Microsoft and Tesla and Google and Facebook. They're all Metcalfe's law, the adoption of a technology. And Bitcoin is the adoption of technology. It's driven by Metcalfe's law, and Metcalfe's law is much faster than a standard cash flow analysis model. It's more valuable. And because the number goes up, it keeps bringing more people into the network, which secures the network and creates a bigger network and more opportunity sets. We've literally not had anything like this before. If you think of social media as an asset, that's kind of where you've got to within this. This is just a technology, right? All of the noise around pristine collateral, all of the stuff Michael Saylor says, that becomes very complicated for people. This is the adoption of a technology that's more suited for the internet age. Simple as that. Technology adoption that is networked uses Metcalfe's law as its model. So how we model it is very simple. The number of active users and the total value transacted. Those are the two big dials. When you map that out for every crypto and you get lots of different values, it's not the value itself, it's the chart of that multiply. Put it against the actual underlying asset, it's the same. So it is exactly this, Metcalfe's law. And so therefore, the value transacted in a number of people means the network is valuable. That's what people have to understand. You can do DCF analysis, discounted cash flow analysis on these. It doesn't work. It's why it didn't work on Amazon. It's why nobody gets Tesla. These are network stocks. These are not classic cash flow stocks. But you have to be a technology investor to understand these things. And once you are, it makes total sense. So the intrinsic value is the use of the network. It's not in the cash flows of the network itself. And the more use of the network and more value of the network that's being used, the more valuable the token is, because the token is the share of the network. Or you can think of it as the value of a slot on the network.
Is there anything about that cycle that we're in right now that has surprised you?
Yes, the business cycle hasn't picked up yet. And the business cycle is the strongest cyclical driver. So we've got the debasement, the printing of money, but really the business cycle has been subdued because interest rates have held high and other factors. So that is what surprised us. But this is really, it's a way of representing the elongated cycle. Normally the ISM would have picked straight up and we would be now with the ISM at, let's say, 57 or something, looking for the peak. But we're not. We're below 50. But the forward-looking indicators suggest that it still continues as normal. So what we've done is taken a business cycle that's this long and stretched it out a bit longer. And what we've seen is this year was that, the extra year in the middle.
What's one of the layer ones that's most interesting to you and why?
So much like the Mag 7, we will have a group of layer ones that will be the foundational layer for this new internet. Bitcoin is not that because it's not a smart contract platform. So it's its own asset that you alluded to before, which plays a very specific and important role. So then you've got the smart contract platforms, and they're driven by Lindy effects, which is how long have they been around and did they fail? Ethereum is the oldest. Now, Ethereum stores more value than anybody else. It has more active users than anybody else because so much is built on Ethereum. Even with the layer 2s, abstracting away some of that, the Ethereum ecosystem is gigantic. Also, because it's been around so long and there's so many validators of the network, it is the most secure. And therefore, things with the highest value will tend to gravitate towards Ethereum.
Raoul Pal explains that the current slowdown in the crypto market is not a sign of weakness but a natural pause before the next major surge. With liquidity tightening and investors losing patience, he believes this phase is necessary to reset the market and flush out short-term speculation. As institutions quietly accumulate positions, Pal remains confident that crypto is preparing for a massive breakout. He predicts that by 2026, global liquidity and institutional adoption will drive crypto to unprecedented levels, transforming it into a $10 trillion asset class. This, he says, will mark the fastest wealth creation period in financial history. What do you think? Are we truly near the start of the next crypto bull run? And which asset do you believe will lead the charge? Bitcoin, Ethereum, or something new? Share your thoughts in the comments.